Let's talk about paying less taxes with a C corporation. And so here's the approach I want you to really pay attention to. So if your family business operates as a C corporation, you want to watch out for double taxation whenever you withdraw cash from the company. And if the corporation has current or accumulated earnings and profits, the IRS generally considers payments to shareholders to be taxable dividends unless there is proof that they were for another purpose, such as compensation for services or payments or on a loan to the company. So the problem is that dividends mean double taxation. So your corporation gets taxed once the income that produces the dividend, and then you get taxed again upon receiving it, right? Fortunately, there are strategies that I'll be sharing with you in today's conversation in terms of paying less taxes as a C corporation. First of all, you want to include third-party debts in the corporation's capital structure. So occasionally, your company may need cash for capital improvements or to finance growing levels of receivables and inventory. And so you generally have two choices. You can inject your own cash into the company or arrange for the company to borrow money from a third-party lender. It can be a bank, it can be a credit union, it can be a series of investors. Okay. From a tax perspective, it's usually better to go the loan route. Why? Because there is less chance you will need to withdraw double taxed dividends later on because you have less of your own money tied up in the business. Be sure that third-party loans are taken out in the corporation's name and not in your name. So we're speaking here about using EIN, using the company's EIN, the employer identification number. This will help you also not only separate your personal affairs from your business affairs, but also help you build business credit. If you borrow personally and then contribute the loan proceeds to the company's capital, you may be forced to withdraw taxable dividends later on to pay the interest and principal on the personal loan. Second thing is, do not contribute capital. You want to make company loans instead, okay? And so let's say you and the other shareholders have more than enough cash to personally fund your company. If you want to fund your family C corporation's growing capital needs. And in that case, it's generally wise to include debt in the company's capital structure as opposed to contributing more equity capital. So arrange for the debt to be owed to you and other shareholders personally, rather than to a third-party lender. That way, you will receive taxable interest payments on the loan without double taxation because your corporation receives an offsetting interest expense deduction. Okay, you also collect tax-free principal payments on the loan. In contrast, if you make a capital contribution and then need to withdraw cash from the business later on, the withdrawals may effectively be double taxed. The third thing you can also do here is to charge your corporation for guaranteeing its debts. That's totally possible, and this will help you also. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. The next thing you want to do if you want to pay less taxes as a C corporation is to lease assets to the company. So it's generally not a good idea for your family C corporation to own assets that are likely to appreciate in value. Why? If the company later sells an appreciated assets or let's say distributes the profits to you, it may be treated as a double taxed dividends. So a smarter tax alternative here is to actually what you want to do is you want to keep personal ownership of a business assets they are expected to appreciate, such as a real estate. Then you want to lease those assets to your C corporation. So if other family members are also shareholders, set up a partnership or LLC to own the assets and lease them to the company. The payments are a deductible expense for the C corporation, so cash comes to you in the forms of lease payments without actually the double taxation. For you personally, these lease payments are taxable income, but you may be able to claim offsetting deductions for depreciation or amortization, interest expense, or on mortgage assets, property taxes, and so on and so forth. Even better, if the assets is eventually sold for a profit, that asset will not be hit with double taxation. So you have you actually are collecting the best of both worlds, if you will. You can also collect generous company-paid salary and perks. So the two more ways to avoid double taxation are with salary and bonus paid to you as a shareholder employee of your family C corporation, and also company-paid fringe benefits provided to you is the shareholder employee. So as long as the salary, bonus, and benefits represent reasonable compensation for your services, the company can deduct them as business expenses. Therefore, double taxation is avoided, and so plus some company paid benefits are tax-free to you, such as contributions to a qualified retirement plan and health insurance coverage. And beware that when a shareholder employee receives a generous package of salary, bonuses, and benefits from a closely held corporation, the IRS might claim the compensation is unreasonably high, and the tax agency can then argue that excess amounts are actually disguised dividends subject to double taxation. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay less taxes with a C corporation. Let me give you a bonus here. If you are listening to me and you are a C corporation and you want to avoid paying taxes, or let's just not avoid paying taxes, you want to pay less taxes. Think about null, for instance, okay? So when we talk about null, you have to understand that the most common ways that corporations reduce their taxable income is through null, accelerated depreciation, tax credits, and profit shifting. So let's talk about null first. So a net operating loss results when a corporation's deductions are greater than its taxable income, and as a C corporation can carry over a null from previous years to lower taxable income for the current year, and this is kind of cool. And now the Inflation Reduction Act of 2022 limits the amounts carried over to 80%. So for example, if a corporation's taxable income is reduced to $3 million and then minus $3 million, not only will they not be able to liable for taxes in the current year, but that loss could also be carried over to the following year's tax return to reduce taxable income. So this is kind of cool. So carry forward and carry back. So this is really good. You also have accelerated depreciation. So when a C corporation purchases an asset, it can deduct the value over the life of the investment from its taxable income. Under the tax code, the firm can actually deduct a greater percentage of an asset's value in the early years of the investment, which lets the firm take advantage of the tax deduction sooner. So this tax provision is called accelerated depreciation. You also have tax credits. You have all kinds of tax credits that can really help your C corporation actually save a lot of cash. For instance, you have research and development. For instance, you also have energy. Those are great places where you can actually have savings. You also can think about profit shifting. So if you're trying to really pay less taxes with a C corporation, profit shifting can be really a great opportunity. So basically, you are able to see exactly what kind of jurisdiction will actually house your taxes or your profits, for that matter. Let me give you a great strategy to reduce C corporation taxes permanently, okay? And again, when we talk about C corporation taxes, we're speaking about an official federal tax rate of 21%. It used to be 38% or 35% back in the days, but the TCJA actually changed everything, so it became really 21%. And there are certain cases where basically you can even pay less if you do the right thing. And there are some states such as Ohio, Texas, and Washington. Corporations are taxed on their gross receipts rather than their income. So it's not the net income, it's the gross income. And one thing you need to really think about in terms of reducing your your C corporation taxes is stock options. And let me explain. Companies often use stock options as a way to compensate company executives, right? Executives are given the option to purchase shares at a set value in the future. And let me give you an example. An executive has the option to purchase 100 shares at $25 per share. After 5 years, the company's stock has doubled. The executive purchases the shares at $25 and sells them for $50, making $25 per share in profits. And when the options are offered, accounting practices require that the company estimate the possible value when the options are exercised. So the value is then recorded as a compensation expense. And when the shares are sold, the company claims the tax deduction for the difference between the option price and the sale value. So this is totally cool, really, really great. And one thing I want to say also is that when we talk about reducing C corporation taxes, it has to be, you have to really think about the long term, because you do not want to take advantage of short-term tax practices that are better for your company, even if they mean that this will be really bad in the future. You want to look at things on a consistent basis, but also on a more granular basis, to make sure that whatever choices you make in the short run will have a positive effect on the business bottom line in the long run, especially when it comes to paying taxes. And again, when we talk about paying taxes, we're not just speaking about paying taxes federally, we're also speaking about paying taxes state-wise, but also think about like county-wide. I mean, there are certain areas where you actually pay taxes not only at the state level, but also at the county, at the city, at a lower level as well. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay less taxes for the C corporation. One thing I want to talk to you about is that if you're trying to really pay less taxes with C corporation, you got to really understand that charitable contributions can also help you out. Okay, C corporations can deduct charitable donations up to 10% of their taxable income. So if they do donate more than the eligible amount, they can carry over the deduction for the next 5 years. So not only do organizations receive a tax deduction, but they can also receive social goodwill. So this is really good. And as the world becomes more focused on environmental, social, and governance issues, ESG, charitable donations improve a company's reputation as a positive contributor to ESG concerns. One thing I want to say also is that when we talk about paying less taxes with a C corporation, you need to understand that stock options are great, charitable donations are great, but all those things, you got to have a great record keeping. So you can't just say, I'm going to deduct this and this and this on my taxes without proof. You got to have proof. It can be canceled checks, it can be receipts, it can be electronic statements, but you got to have proof. And it's one of those things where you have to substantiate things. Okay, it's the same thing for corporate tax credits. I mean, corporate tax credits are another way to reduce your C corporation's taxes. But again, as I said earlier, it's one of those things where you got to have the proper documentation so that if you were ever audited, your company can prove that it does meet the requirements to actually to benefit from those corporate tax credits. And one thing I want to say here is that when we talk about corporate tax credits, you have something called general business credits. This refers to a group of credits available to all businesses, including C corporations, S corporations, LLCs, and partnerships. Okay, and so this includes things like Social Security. You have employer-provided child care credits, and you also have things like employment credits. You have research, you have orphan drug. Now, those applies to specific industries, okay? And so orphan drug is really for healthcare, but you also have a research credit, so those are really important as well. You also have other credits, and so we're speaking about orphan drug credits, and now those credits are for big pharma, or let's say pharmaceutical companies or research entities. And it's one of those things where if you're a C corporation and you are in that space, you are basically able to you're able to lower your tax rates, and so that you are able to know exactly how much you are going to pay in the long run. One thing I want to say also is that when we talk about actually paying less taxes with C corporation, you can also avail yourself of the employment credits. Okay, and so let me give you an example. A work opportunity tax credit is a temporary tax credit. And so this credit is available through 2025 for companies that hire qualified workers, such as veterans, ex-felons, and SNAP recipients. And the credit is based on the first $6,000 paid to a qualified employee in a year. For employees working 120 to 400 hours, the credit is 25% of the wages. So this is kind of cool. And employees working more than 400 hours, the credit actually for those employees is based on 40% of the wages. And the credit cannot exceed $2,400 per employee. So if you're a C corporation and you're trying to really reduce your taxes, your corporate taxes, avail yourself of employment credits. one thing I want to say here also is that you are able to see exactly what really works for your company, and you can apply what works and what doesn't work. But I want to insist on the fact that I want to insist on something I just said a few minutes ago. You gotta have great record keeping. So record keeping really will for you to actually avail yourself of all the credits that I just mentioned to you, and also all the deductions, like null, accelerated depreciation, tax credits, all those things. You gotta have proper planning. If you were to be audited and the IRS wanted to learn a little more about your business, it's just one of those things where you have to be able to show proof of all the documents that you actually listed when filing tax returns. But remember, a C corporation actually is required to file a Form 1120 by April 15th every single year. But Form 1120 is not the only form that it has to file. You have a constellation of ancillary forms that need to be filed, including 940 and 941. And one thing I also need to I want to also talk about is that you are able to see exactly what really works and what doesn't work. Because if the bottom line for you is to pay less taxes with C corporation, you want to think of it as an investment, right? You're not going to see results right away, but you will see results in the long run. And the results here is that you are paying less taxes with your C corporation, and you're doing so legally, though. The whole thing has to be legal. So when we talk about paying less taxes for within C corporation, you have to really understand all kinds of laws that revolve around how C corporation, S corporation, and LLC operates in this country. And an important element about the TCJA is that it really is helping C corporations pay less taxes, in a fair manner. So the TCJA is the Tax Cuts and Jobs Act, and this is really the piece of legislation that has brought down the corporate tax rate from 35%, if you will, to 21%. And it's one of those things where you need to understand there's a huge delta between how much corporations are charged in terms of their maximum tax rate and how much individuals are charged. I mean, right now, the individuals are charged with the maximum tax rate of 38 to 39%. And it's one of those things where you have to see exactly what works for your situation. And one thing I also want to say before closing to this conversation here is that you need to understand that you got to really pay attention to conversions. But those conversions could be costly. They could be difficult. So depending on how much tax you can save, converting to a C corporation may not be worth it. It can be expensive and time consuming to convert to a C corporation under state law. And so if you are an LLC or a partnership, S corporations can revoke their status and become a C corporation if a majority of shareholders actually agree to it. And most firms use lawyers to incorporate and help them draft a set of articles of incorporation, bylaws, name corporate officers and directors, and issue stock certificates. Thus, the legal fees actually can be a factor. So you got to really pay attention to what really works for you. Again, it's not just about the money, but they should be important also to know exactly what you're getting yourself into now and in the long run. Thank you so much for your attention. I really appreciate it. Today's conversation, I just spoke to you about how to pay less taxes with C corporation, and I give you the approach, the bonus, the strategy, and then finally the pro tips. Thank you so much. God bless you. I see you next time. But until then, remember, stay marvelous.